Okay, welcome back. As promised, let's focus on Samvardhana Motherson now. First quarter was a slightly mixed one, with EBITDA margin coming in slightly below street expectations. Revenue growth was healthy, though. Gross debt increased in the quarter gone by as well. We'll talk more about this. We have Pankaj Mittal, Chief Operating Officer at the company. Kunal Malani is CFO at the company. Gentlemen, great to have both of you here, Pankaj and Kunal. Appreciate you joining in. Kunal, if I can come to you first. Revenue growth has come in at 29%, and it's better than what the street was expecting. But you mentioned that this is despite muted industry volume growth. Can we begin there? I mean, what do you mean by that?
Look, the industry volumes were pretty much flattish across the globe. Having said that, you had Europe and US, which were slightly down versus expectations at least. Europe was around about 7% down. But it was made up by India and China, and that's the benefit for a player like us by being diversified across so many geographies. A lot of, let's say, volatilities around certain countries and geographies or products and customers gets muted in Motherson because of the sheer diversity that we have, and hence it's a much more resilient model, if I were to put it. And that's what you're seeing, that in spite of muted volumes, we've been able to deliver pretty stellar growth.
But if industry volumes stay this way, you have to work doubly harder, right, to kind of outperform. You don't have that tailwind of the industry. What does that mean for the overall growth for the company for the full year?
Difficult to predict in that sense because there's obviously unclear picture in terms of which parts of the world will do what. There is a degree of softness that is being seen in Europe right now, largely on account of how EVs are getting, the scale of the growth that was expected in EVs is getting muted a bit. And that's largely causing the impact. In fact, on the ICE side, we are seeing an elongation of the existing programs. Hybrid seems to be catching a lot more interest and seems to be the highest growing segment right now, pretty much if you look across the globe. So all in all, I think the content part of it continues to grow. There is more SUVs being sold. There is more premiumization that is happening. And hence, for someone like us who is more positioned in that set of the market, we continue to see growth. We have 83.4 billion order book to be executed. So in some way, we may have gained share, not that we track it, but we may have gained share. And hence, that may also augur well as we move through the year.
Pankaj, just to sort of talk about this issue with the container costs, I believe this has been a bit of a dampener as well. I mean, do they still remain as elevated? And what is the outlook? And what could be the potential business impact if these rates remain where they are?
Well, thank you for having us on your show today. For us, we are a very well-positioned company because Motherson has its plants in the same geographies where the customers are located. So we are not a big exporter of products from one country to another, and that puts us into a very big advantage. The container issues do lead to some of the child parts which move from one country to another, and it's a global world supply chain. So that they may lead to some inventory buildups of the child parts, but majorly for us as a company which has its plants in Europe and China for China, North America for the North American region, South America has its plant in South America. So we are very well positioned, even in these disruptive times, to be a reliable partner to our customers.
Okay, so could you give us, I mean, since this is not something that seems too bothersome for you right now, but, in light of what Kunal also said in terms of Europe demand and EVs being a bit soft, how is the rest of the year looking? Some sense in terms of just top-line growth, revenue. Whether it's going to be, a flatline sort of a situation that we're looking at, or whether you'll manage 15-20%, some sense.
See, Motherson has evolved to be a very diversified and robust company. So that's reflected from our results. You would see that financially also in these very uncertain times, very difficult to predict. But what is more important is to have financial prudence. And we have maintained that with a leverage ratio of 1.5, despite large M&A payouts and also growth capex. So we are growing and setting up new facilities, greenfield sites in developing economies where the growth is coming. Also in the developed markets, if we see the movement of the vehicles, it's towards upscaling. So the premiumization and SUV trend is growing. It's growing both in the developed market as well as in the developing markets. So they are also helping us in the growing the content per car. We, being an acquisitive company, believe that in uncertain times when larger capacities would be available, extra capacities are available, there would be more options for us being given by the customers to look at even more M&As. So that's the direction. So when you look at it, and not just the automotive side, the company is also growing very well in the non-automotive business as well. So in a diversified platform, we do see a very good future coming forward.
Hi, Pankaj and Kunal. Good morning, and thanks so much for speaking to us. Let's try to get some quantitative numbers out. You know, we have got the qualitative aspects. So you mentioned that maybe inorganic growth is something that you're looking at. You'll have a capex spend, I think, of around 5,000 crores for the year. So tell us, what kind of debt levels are you all comfortable with? As of now, the gross debt is around 20,000 crores. The net debt is around 13,000 crores. So how comfortable are you all with regard to this debt number, and what is the outlook from here on? And also, your working capital days got a little bit stretched in the first quarter. Where does it normalize at?
So one, I think we're very comfortable with our current debt levels. Our financial policy is 2.5 times net debt to EBITDA. We are at 1.5, which has traditionally been our comfort levels. And hence, this is not really a challenge for us because you've got to see the aggregate debt in the context of the size and scale of the business as well. Where we see the business heading towards, I think with whatever that we know today, we should still be deleveraging. The working capital expansion that you saw was partly driven by the Red Sea crisis, where we had to keep some of the extra inventories in place, partly driven by volatilities in the customer production schedule because supply chain was a bit disrupted. And hence, and then there is a large order book of 83 odd billion plus, which will come, part of it, which will start coming into SOPs in the latter part of this year, for which inventory has already got built up. And hence, in the latter part of the year, we should see working capital getting more normalized. And that should again release cash from the perspective of how our debt looks like, besides generating the profits and cash flows during this period as well. So overall, hence we believe we should deliver from 1.5. I would estimate this to be somewhere around the 1x levels, give or take, or maybe even better, depending how things play out. So debt really is not a concern. All of this is obviously keeping in perspective the announced transactions only on the inorganic side, and nothing new that has been considered in these estimates when we look forward.
But some new transactions are coming. That's the hint that Pankaj was giving us. Pankaj?
Well, as Kunal said, also that these numbers which he's giving and deleveraging of our ratios is going to happen if the new acquisitions, because we being acquisitive company and being a reliable partner to our customers, there are a lot of options and opportunities which are being provided by our customers.
So there is, I mean, you're telling us that you are looking at newer targets?
Always Motherson has been, yes, always Motherson has been provided with many opportunities. We evaluate them very carefully. And if they are good for all the stakeholders, we go ahead with them.
I mean, you know, I was thinking that lots of acquisitions at maybe 5, 6, 7 years ago, one would wonder, well, how are you going to do, how are you going to sort of combine all of them and sort of bring it to fruition in a very productive way. But one of the things that you said, Pankaj and Kunal, it really struck a chord that the world is actually a very different place now, right? And having manufacturing plants in countries where you got to supply the product to becomes important, because I mean tariffs are going up around the world, especially in the US. I mean, I think the direction of travel on tariffs is up, not down, everywhere pretty much. And in that sense, you're sort of well distributed. So that's a good thing. But nothing. You'd announce something new in this over the next 3-4 months, Pankaj, possible? And how large, if so, if you can tell us?
Well, acquisitions are such a thing that till it happens, one can't announce or say anything, because it has to be value accretive to the stakeholders. And we continue to work together with all the partners all the customers to find solutions. So that's how we all are. So the moment something fructifies, we will be announcing it.
Okay, all right, Pankaj and Kunal, thanks a lot for joining in and giving us those details.